This past week, the Wall Street Journal has written an expose on how America is wrapped in miles of toxic lead cables. They call out in particular AT&T, Verizon, along with other telecom giants like Lumen, how they've left behind a sprawling network of cables covered in toxic lead that stretches across the United States. They've uncovered potentially more than 2,000 lead-covered cables throughout the United States that haven't been addressed, and in many instances, more than 4 dozen locations that were independently tested by the Wall Street Journal and other labs, where they've shown that lead levels in sediment and soil exceeds the safety recommendations by the U.S. Environmental Protection Agency. In one instance, in Lake Tahoe, the Wall Street Journal water sample had lead that was more than 2,500 times more than what the EPA limit was for drinking water. So this is a nasty headline. Reading the Wall Street Journal article, which I recommend you do, it's very clear that this is not contained just to one place. This is possibly throughout the United States, not just in Lake Tahoe, but by playgrounds, by schools, by neighborhoods. And this does create the risk of an open-ended liability for companies like AT&T and Verizon. And so in this video, I'm going to talk about what does it potentially mean for the stock, why AT&T and Verizon are not part of my own investment journey, and where do you go from here if you are a shareholder in AT&T and Verizon. If you enjoy educational investment videos, please make a point of hitting that subscribe button. You're watching Unrivaled Investing. So let's dive right in to understand a little bit of the history. So between the late 1800s and the 1960s, the American Telephone and Telegraph Company, aka Ma Bell, was responsible, and that's after Alexander Graham Bell, the founder of modern-day telephone. So AT&T, the legacy AT&T, was responsible for installing almost all the telephone cables across the United States. These cables were composed of numerous intertwined copper wires, and to protect them, a substantial layer of lead was applied. This lead casing served to insulate the cables, prevent corrosion, and protect them from water damage. The problem was, only later, with new technology and broader awareness, did they replace the poisonous lead coverings with plastic and fiber sheathing. The problem is, once again, this was too late, and people and employees, telecom employees, were already exposed. One quote was, "I was really sick and I didn't know from what." This is from a telecom employee being exposed to lead cables. And so looking at, well, what's this have to do with AT&T and Verizon, the modern day stocks? Well, the Bell system was split up by U.S. antitrust initiatives in the early 1980s, 1984, and they were split into several regional telecom providers. Then through a series of mergers and acquisitions, they ultimately formed into the modern day AT&T and Verizon and Lumen. So these current public companies, AT&T, Verizon, and Lumen, all can trace their history through decades back to the original AT&T that was laying these toxic cables covered, with the toxic lead sheathing. And that's why, you're seeing this hit to AT&T and Verizon stock today, where it's this uncertainty of what's the liability tied to what the legacy AT&T laid in terms of their infrastructure. And so Verizon down around 8% today, now around an 8% dividend yield because of these very questions and this uncertainty. So the question is, okay, so what's next? What happens from here? First of all, in full disclosure, this is not financial advice. If you're looking to take charge of your investment journey, consider unrivaledinvesting.com for compelling investment ideas, real-time portfolio updates, and our exclusive Discord server available for annual subscribers. And so as we look at this, I think there are a few key questions that if you are a shareholder in AT&T or Verizon, that you need to consider these key aspects. I'm personally not, and I'll talk about why in just a second. But let's first consider what are the key questions you need to ask, because I think a lot of Verizon and AT&T shareholders are waking up saying, oh my goodness, what do I do from here? So the first question is you need to ask yourself, if you're a shareholder in these companies, you need to think about what's the potential liability that they may have to pay for, in terms of remediating, solving this problem of legacy lead cables potentially infecting communities. One research analyst downgrading AT&T stock, one analyst estimating it could cost nearly $60 billion throughout the United States to remove these lead cables left behind the legacy phone companies. So the first question that you would want to ask yourself, and this is part of the reason why the stock is selling off, is because you would need to assess what is that liability. If you can't assess it, then a lot of folks are just selling. So that's why you're seeing the sell-off, is people are saying, I couldn't I didn't price this historically. And you're not alone. I check AI Ticker Chat, which leverages artificial intelligence to help me with my own personal analysis for various different companies. And I asked it about Verizon Communications. I said, look, looking at their most recent annual report, is there any mention of legacy lead insulated wires they might need to remove and the associated cost in the future? And there really isn't any mention of it. They do mention that they're going to have to replace, legacy 3G network equipment, but no real mention of legacy, lead liabilities here. And so it does create the risk that in addition to their $150 billion in debt, you could have tens of billions of dollars of additional debt if, let's say, lawsuits go a certain way that could go onto Verizon's balance sheet and AT&T's balance sheet. So I would expect to see lawsuits in the future, this uncertainty. And I do look at something like AT&T where I'm seeing something with a huge amount of debt, and it's just starting to be priced in. I think that's why you're seeing the stock fall, is this investors are just starting to say, okay, how much of a liability is this? People are just starting to do the work of how open-ended is this? Is this a $30 billion liability? Is it a $60 billion liability? People don't really know, because you're going to have to go cable by cable throughout the United States and even find out. The Wall Street Journal was making the point that it's difficult to even find out who owns some of these cables. And in many instances, they're not being used and they've just been sitting there, for years and years, creating some sort of liability that, it's who really wants to take ownership of, and it may be tied to a prior company. So potentially tens of billions of liabilities, $150 billion of existing debt. And I look at this debt level for Verizon in particular, it's a lot of debt. Now, part of the reason why they've historically been comfortable doing it is just because of the high degree of recurring revenue. When you have your mobile phone plan, people generally, it's one of the last things that you're going to cancel. And so very stable business. But when I look at this business, it's not like it's growing very significantly. It's not like they're just mountains of free cash flow relative to their dividend. I mean, in the most recent quarter, they call out how their free cash flow was $2.3 billion and their dividends paid was $2.7 billion. This is obviously not sustainable long term. Long term, you need to have something where your dividends are less than your free cash flow. Otherwise, you're using debt to pay the dividend. So that is not a sustainable quarter, but over time they've historically showed that they at least can do it. I mean, the last 2 years, their free cash flow was between $14 and $19 billion, and their dividend was closer to $11 billion. So I look at this and I'm thinking, Verizon, this isn't like a hyper growth company or anything like that. Growth is not going to be the key driver of your return. You can look at their most recent, annual results. You're talking about effectively flat, slightly declining profitability. So looking at this company, and this is why it's so important for any company to figure out what's going to drive my return. So there's really three things. There's cash, it can be dividends, it can be spinoffs. So there's cash, there's valuation, and there's growth. And so I'm thinking about these three different things for something like Verizon. I'm not seeing hyper growth, maybe single digits in the periods ahead, maybe decline. I mean, the most recent quarter, you were seeing a decline in revenue. In terms of cash, you're looking at, well, can that dividend be sustained? I personally look at this and I suspect that their dividend will be sustained. That's what I suspect for now. Keep in mind, this is a guesstimate. I do not have skin in the game on Verizon or AT&T, but I figured people might want to hear my guesstimate, my opinion on this. And so at this point, I suspect you would see the dividends held, at least for Verizon. I haven't looked into AT&T, unless their business starts declining materially, which you're not seeing yet. The challenge is that, once again, what's driving your return? So you have cash, and that's around an 8% yield for Verizon. You have limited growth, and really, are you going to see tremendous valuation expansion? So that's why it's not part of my own personal investment journeys. Long term, I want to focus on things that can grow significantly and maybe even get some valuation expansion. And that, I want to find the things that can, do 10, 15, 20% annualized returns over time versus looking at a dividend where you start creating this uncertainty of, will I get it because of these open-ended liabilities? So if I were a shareholder, I would need to get comfort in the idea that these liabilities will not be over, let's say, $60 billion, which even still, that they might, that is a lot of money to add to the existing liabilities of $150 billion alone for Verizon in terms of their financial liabilities. So I suspect if it's $60 billion for the total US, and let's say Verizon gets $20 billion of that, 20 to let's say $30 billion, I suspect they would probably be able to cover that, but it would be an unpleasant experience. It doesn't help the long-term enterprise value of the business. That's an additional liability that's going to need to get repaid, especially when, you have cash now yielding, 4 or 5%. And so as a shareholder, you need to be asking yourself, well, wait a second, would I rather get 8% with this open-ended risk of, toxic lead exposure, or would I rather get closer to, 4 or 5%, in cash? I personally use Interactive Brokers, see the link below, I think it's 4.6% on cash now. Would I rather just sit and get that on cash and not have to deal with this sort of uncertainty of, does the business melt down over time? Does the business, have this challenge of repaying, this huge environmental remediation liability? And so I personally, it's just way too hard for me, to do that. I would, if for me personally as an investor, given the no growth or limited growth, I would need to see a double-digit dividend just to get me excited or interested. Like I would need to see like a 14% dividend on something like Verizon before I'd say, okay, well, how stable is it, before I'd start, diving deeper into that potential, remediation and liability concern regarding this legacy, toxic lead exposure. So if this video has been helpful for you, please make a point of hitting that thumbs up, hit that subscribe button. If you have a different opinion on the Wall Street Journal article or what this liability could mean for AT&T or Verizon, I'd absolutely love to hear it. Also, if you want me to do a different video or a detailed dive into Verizon's financials or AT&T's financials, leave a comment below and maybe I'll consider it in future videos. Thanks so much for tuning in.